This special podcast is brought to you by Futuregrowth Asset Management, and Jason Lightfoot from Futuregrowth is with us on the line. There's been a lot of talk lately about credit rating agencies, Jason. Not too many people know the background to them. We know they've been around for a long time and they play an important part in the world's financial system. But where do they come from?
Yeah, Alec, in essence, credit rating agencies serve the purpose of potentially, assisting borrowers to access capital primarily from public capital markets. And these ratings are issued by credit rating agencies as such. They range from, various rating scales from your typical AAAs, which are deemed the most highest credit quality, right through to sub-investment grade debt, which falls below BBB minus ratings. So the idea is what they do is they conduct independent analysis and provide information around the creditworthiness of those borrowers to the buyers of such debt. So it gives buyers a good sense of what's the probability of default of those potential issuers of debt in the market.
Who would they employ? Who would go and work for credit rating agencies?
So in essence, they employ a range of analysts who are deemed to be credit analysts who in essence analyze the creditworthiness of the particular issuers who come to them. So in essence, there's a particular company will come to a credit rating agency to in essence get a sense of their creditworthiness. And
then their business model, if I understand correctly, is the organization they're going to do the credit rating on is the one who actually pays them.
Yeah, in essence, there is quite a conflict in that regard, because in essence the company looking for the rating is in essence paying for it. That's correct.
And so if the company doesn't like the rating that the ratings agency brings up?
Yeah, there's a conflict there. So they could potentially say, no, we don't like that particular rating. It's too low in our minds. It's going to result in a higher cost of borrowing for us. Let's go to somebody else.
Okay, there are three that we know of, Moody's, Fitch and S&P. Are they all rated equally by someone like you who clearly has to decide whether or not to believe the ratings that they put on companies?
I think regardless of who they are, they should be seen as a mere input into the investment process. It's very much akin to the like of, broker research in the equity world, where, it's just really an input. It's an opinion, really. It's not really a hard and fast rule that you say that, that particular borrower is rated at a particular rating, and that's what its rating is. One needs to obviously assign your own independent analysis to the creditworthiness of the particular issues.
So if you see a Moody's rating, you don't necessarily believe that it's accurate one way or the other?
As I said, John, it's merely an opinion, really. It's nothing more than that.
Because so much is made of them. Every time a rating agency comes out with, say, on a sovereign rating on South Africa, and they decide to drop their ratings of the country's foreign debt, we all get a panic as a result of that. Should we be taking this more in our stride?
Yeah, obviously it is a concern when they change the rating of, on a sovereign point of view, because that results in an increase in the cost of borrowing for that particular entity. So it obviously has impacts on the rand, as an example. So it does have knock-on effects.
And how many of those, if you have a look at South Africa's sovereign rating at the moment, where do we stand? Are they all equal, Fitch, S&P and Moody's?
They're in a similar sort of band. If we look at S&P, they've got South Africa sovereign rating as a BBB minus, as opposed to Moody's, which has it as a BBB flat. With obviously different views. It's all based on sluggish outlook on the economy, reduced tax collections, obviously certain structural issues on concerns around labor and economic reforms, those sorts of things.
How big a difference then is it from, as you say, Moody's at a BBB plus and S&P on a BBB minus? It seems like it's three different levels. Is it that relevant?
It is in the same sort of band, but if you look at the S&P rating, which is at BBB minus, which is at investment grade, so the next level is sub-investment grade. So that's going to have potential severe impacts for the sovereign from a borrowing point of view if they had to issue bonds in the foreign market.
But if S&P drops it below investment grade, that doesn't necessarily mean that Moody's and Fitch would as well.
No, not likely. It was obviously they look at things in various different lights. But it will have an impact because S&P are regarded as one of the top rating agencies. Sure, they're all probably rated in an equal sense, but if I had to rate them, probably Moody's is up there.
Sorry, if you had to rate them, would you say Moody's is...
Yeah, I'd say they're probably on the equal sort of standing, but, they look at various things, so different investors around the world will probably hold various opinions in high regard. So, for example, guys in the US might prefer S&P versus the European investors who might prefer Moody's, as an example.
Because we did have that difference in opinion, didn't we, over Capitec, for instance, where the one came out and said, we think Capitec needs to be downgraded 2 notches, whereas another one came out and said, no, we think Capitec is absolutely fine.
Yeah, that's correct. Yeah. I mean, it was actually, in fact, Moody's that downgraded them right down to BBB+, in fact. And that was obviously based on the whole Abil thing and the haircut that senior unsecured investors are likely to receive, post the fact that the Reserve Bank isn't going to necessarily bail out bondholders going forward. And that's also the whole reason why the big 4 banks were downgraded as well by Moody's.
Abil's an interesting point, because if a credit rating agency is going to be the canary in the financial coal mine, perhaps they should have been chirping a little louder.
Yeah, that is a criticism they have received over the last couple of years, where they are more reactive as opposed to being proactive, really just downgrading post the events, And we obviously saw the concerns around during the subprime crisis, where the so-called structures were rated AAA, in fact, and they were, in fact, not quite that what they should have been. They were probably below investment grade, given the fact that the underlying loans were subprime loans, and underlying borrowers were defaulting on their loans, and they weren't reacting on that bad news.
It's interesting. Sometimes people say, well, democracy is not a great system of government, but it's the best we've got. Is it a similar thing with ratings agencies? It's not great, but there isn't anything better at the moment.
Yeah, I mean, it's improving. I mean, recently the government enacted the recent Credit Rating Services Act, which to a certain degree introduces higher standards of independence, diligence, and requires also the registration of rating agencies. And with that, it goes hand in hand with having certain internal controls of conduct and compliance. So, in a certain extent, it is improving the role of credit rating agencies in the current environment.
But your point, right, that you made right at the beginning was it's not gospel.
It's not gospel. It's an input. It's an opinion, really. Again, previously in legislation, the old Reg 28 pension fund rules, as well as unit trust fiscal regulations, had a requirement where investments from a debt point of view had to be officially rated by credit rating agencies. Now that's been taken away in its entirety, where investors have to take the responsibility themselves for ensuring that they understand the creditworthiness of the loans that they make.
That's interesting. How does it affect your life?
Obviously, in our view, is that we've always been well suited to ensure that we are well abreast of what the requirements are and what we need to be aware of in terms of assessing the underlying creditworthiness of borrowers. So I think for the industry wide, it's resulting in that investment firms had to ensure that they bulk up and ensure that the underlying analysts are brought up to speed in terms of assessing the underlying risks.
So whereas in the past they might have just, if you like, outsourced that or delegated that responsibility to the ratings agency, they're having to take more
Correct.
Responsibility now.
No, that's pretty much what was done in the past, and particularly if I refer back to the subprime crisis, the investors were looking at the AAA rating and thought, well, great, highest credit quality, let's buy it into our funds. So to a certain extent, as teams, it's a whole progression in terms of bringing people up to speed. So to a certain extent, some investment firms will still rely on external ratings until that point where they obviously are brought up to speed and have the capability internally to assess the risks.
Insights from Jason Lightfoot from Futuregrowth, and this special podcast was brought to you by Futuregrowth Asset Management.